Hello and good evening everyone. I'm Abhijit and welcome to a new episode of Investing Fool. Usually when we do videos on Saturday, we tend to talk more about general topics rather than the portfolio. So in line with that, today we'll be discussing about a Sharpe ratio, what it is and why I use that in ranking the stocks for my momentum portfolio. And we'll also look at a simple way of calculating the Sharpe ratios for any stock on Google Sheets. With different look back periods. I'll also share a link of that sheet in the video description in case any of you want to just explore it. After that, we'll take a short look at the portfolio and not a lot to say there, but this is our first video after the rate cuts, the much anticipated rate cuts which turned out to be 50 bips. And after one day of setback, after the rate cuts, the markets have resumed on a bullish trend along with global markets. So Nifty is at an all-time high and most of the stocks closed pretty well on Friday. So we'll discuss that at the end of this video, but let's get started with the topic and I'll try to keep it as short as possible. So if I show you the chart on the right hand side and say these are the price charts of two different stocks, stocks A and stock B, which one of you would you like to have in your portfolio? Most people would go with stock B. And why is that the case? That is the case because as investors, as humans in general, we tend to value consistency and predictability in the things that we do, in the things that we own, right? So if you look at the paths of stock A and stock B, and right at the outset, I should say that no stock in the world is ever going to be as smooth as stock B. It's basically like a fixed deposit. It's basically like liquid case, and I mean it's a linear curve, right? But it's just to illustrate the point, to drive home the point of the difference and why we are going towards sharp returns, right? So if you look at the starting points and end points of both these stocks, they're the same. Both are starting at 100. Both are going till 170. But if you look at the way stock A is going to reach 170, so it sometimes it goes high like crazy, then it has huge falls, right? So there is a lot of variability, but ultimately it reaches where stock B reaches, although in a much more predictable, slow, gradual way, right? So if I have a portfolio of 20 stocks, I would not want stocks like stock A, right? So if I have like 20 stocks like stock A, my portfolio would be going haywire all the time, right? Which I do not want. So we want smoother returns if that is possible. So those of you who are familiar with momentum investing, you would know that we use a lot of indicators to rank stocks when creating a momentum portfolio. One of the most frequently used and one of the simplest and most understated indicators is the absolute return over some time period, typically 1 year, right? Most academic papers use this 12-month minus 1 month rate of change, which basically means you take the latest like the last year rate of change, you ignore the most recent 1 month's data and you rank the stocks based on that. If you go to Momo India screener also, which we use for creating our portfolio and for rebalancing our portfolio, you can see in the sort by drop down there are so many options, right? There are so many permutations and combinations of different things. There are individual look back periods, there are average of different look back periods, there are absolute returns, sharp returns, there are like returns divided by beta. So all these things are there and there is no one right answer for what you should pick for your momentum strategy, and that is not the purpose of this video as well. In the long term, the return profiles of many of these indicators have a very high likelihood of converging as well. But coming back to the point, both stock A and stock B are taking you from 100 to 170, but the journey to reach to that destination is very different in case of stock A, right? It will give you a couple of heart attacks while you are remaining invested in that stock. But basically the volatility that is there or the variability in price that is there in stock A, that information gets lost when you rank stocks by absolute returns. And here I'm not suggesting in any way that absolute returns is bad or anything, right? In fact, it is one of the most understated it is the simplest indicator for momentum. And if you just consistently do like a 1 year look back also, right, you have a very high likelihood of beating the markets. So that is something that you should always have in mind. But here we are qualifying it with some additional thing, because we want more stocks like stock B versus stock A, right? So what do we do? And here is where Sharpe ratio comes in. So Sharpe was proposed, I think, by William Sharpe, who was an economist, and it is a basic measure of risk adjusted returns. Now, risk has many definitions and connotations in finance, but one of the most frequently used means is to gauge the volatility, to gauge the price volatility of the stock. So that is taken as a measure of risk. So if we take that measure of risk, right, how do we adjust the returns? We basically divide the absolute returns by the volatility of the stock. So we'll take a look at how we do that on Google Sheet. But in essence, Sharpe is a way of penalizing stocks which show huge volatility, right? So when you divide the returns by volatility, the stocks that would have huge volatility, they would have lesser Sharpe returns, right, compared to stocks which have less volatility. But if you take just absolute returns for both these, so the problem is, if you take absolute returns for both of these stocks from 100 to 170, the absolute return is 70%, right? So the ranks would be same for both of these stocks, which is what you do not want. You want the rank of stock B to be higher than stock A, because although they are reaching the same point in the same time, stock A you want to penalize because it has a lot of volatility, right? You do not want that in your portfolio. So that is why we use Sharpe returns as a measure to as our momentum indicator. I use the average of 3 months, 6 months, 9 months and 12-month Sharpe returns to rank stocks, and this is what we'll discuss on the Google Sheets as well. Now, there are multiple approaches which are practiced by DIY momentum investors to contain the risk, right? Some of these have lesser of an impact, some of these have more of an impact, and a lot of these can be used parallelly also, right? For example, there are some methods like removing high beta stocks. That is one way of containing some bit of risk in your portfolio. The return profiles may not vary much, but in terms of the drawdowns, if it is able to minimize the drawdown even a little bit, that's a plus for me, right? So I typically do not take anything more than 1.5, a beta of 1.5 in my portfolio. But anyway, we are not talking about beta, we are just talking about different ways in which you can think about curtailing some of the risk in your portfolio. So a high beta filter is probably one way. Using Sharpe returns instead of absolute returns, which is what we are discussing now, that is probably another way. Using Sharpe returns by beta, this is also a beautiful way of preferring low volatility stocks, because when you divide by beta, stocks that have very high beta, their value would come out to be very low, right? So they would be ranked much further down. In fact, we can try it out right now. Rather than this, if I just take average Sharpe of 12, 9, 6 and 3 months, but I divide them by beta, right? So just see what kind of stocks I would get in the screener. They would be very low beta. So you can see almost all of these stocks. Just let this page reload. Yeah, you can see all of these stocks, right? They're very low beta, and that is why they are at the top of the rank. So a lot of pharma stocks are there. Even Marico is there, right? Marico is not even I don't think it is in the top 50 in my screener also. But if you want to drill down risk further and penalize beta so much, then you can use something like this also. So there are basically various methods that exist to contain risk. There is no one right method. You have to choose for yourself. Another method is taking a composite ranking, taking multiple factors. One is momentum, one is low volatility. You rank by momentum, you rank by low volatility, and then you create a composite rank out of those two rankings, right? So that is another way to look at it. As I said, I personally use 3 months, 6 months, 9 months, and 12 months average Sharpe returns to rank our stocks. So let's take a look at the Google Sheets. And we have previously discussed in one of our videos how to calculate beta. So it is very similar to that. In fact, I've added the beta section also here. So in the same sheet also, you can just change the stock name and you will get the Sharpe returns and the beta for the stock here. So yeah, so on the leftmost side, we have created an index to get the dates, and then from yesterday we look back to 1 year, and these are the dates. We take the stock prices, we pull the stock prices and the index price. So index here is Nifty 50, as you can see here in cell I5. So we take the stock price and we take the Nifty 50 price on that day. So whatever day it is, this row corresponds, this prices correspond to this date, and then we calculate the 1 day change for both the stock price and the index as well, right? So the 1 day changes are taken up in this column. Now, once we do that, the next thing that we do, let's first understand how to calculate Sharpe returns for 1 year look back, and then the same thing we basically apply to 9 months, 6 months, 3 months, and then we get the average. So first we take the 12 months daily volatility, which is basically the standard deviation of the daily returns over 1 year. So here we are getting the daily returns over 1 year. We take the standard deviation of that and we arrive at the 12 months daily volatility. Now we have to annualize that volatility, right? To annualize that volatility, we multiply it by square root of 252. Why is that the case? Because 252 is the typical number of trading days in a year that we consider. Okay, so we get the 12-month annualized volatility here. Now we have the 12-month rate of change, or ROC, which is basically the absolute return. So just current market price by the price 1 year ago minus 1, you get the 1 year change, right? The 1 year rate of change. So to get the Sharpe return, you basically divide this 12-month ROC by your 12-month annualized volatility, and that gives you the 12-month Sharpe return. So you basically take this 263.93 and you divide by this. This is in percentage, of course. Then you get a Sharpe return of 7.27 for 1 year. Now, when you go for different look back periods, you have to do the same thing. Standard deviation of daily returns. So here you are taking 1 year. So here you will take 9 months, and you will again multiply by square root of 252 to analyze the 9-month daily volatility, right? So you get the 9-month annualized volatility, and then after that you similarly you just divide by the 9-month ROC, and you get the 9-month Sharpe return. So this the same way you continue basically for 6 months and 3 months. And then the parameter that I use on the Momo India screener is to calculate the average Sharpe of all these 4 look back periods. So 3, 6, 9 and 12 months, I reach an average Sharpe, and based on this number, this singular number, all of these stocks are ranked, right? So filters are applied first. So whatever stock has fallen from 25% from its all-time high, all those filters are there. Those will be applied first. Whatever remaining stocks you get out of this universe, rank them get this value basically for all of these stocks, and then just sort them in decreasing order, and then you get your top ranks. Okay. Now there is a better way actually. So here we are calculating directly the average of the different Sharpe returns, right? A better way is to take the 12-month Sharpe return, create the rank, 9-month Sharpe return, create another set of ranks, 6 months, 3 months, again separate set of ranks, and then you create a composite rank out of these 4, rather than creating a Sharpe of this, creating an average of all the Sharpe numbers directly. Why that is the case? That is because if let's say some stock has risen too much in the last 3 months, okay, so there is a very high propensity for it to skew the overall, I mean this average number, right? The average would also always get skewed by outliers. So that is the only concern that we have with this, and that is why I feel it is a little bit better to do 4 different rankings and then create one rank out of them, right? So but like I haven't tested how much of an impact it would really make. Maybe the impact is not as big as I think, but that is just something to keep in mind. Okay. Beta we had already discussed in one of the previous videos. So anyway, that same thing is just copied here. You can watch that video also if you want. And basically, so what you need to do is just change the stock name here, right? Nothing else needs to be done. So Trent, you can see the massive returns that it has given over 12 months. It's still very scary, 264% in 1 year, and 9 month also 150%. It's going pretty great. But so one of the issues with the formulas that are used here is a lot of times Google Finance isn't able to fetch the results for the price on some particular day. I don't know why that happens, but that is the case. So the formulas are in fact very simple, but here they are a little bit like lengthy, because we are eliminating empty values from these columns. So if I like just scroll down, you can see these values, right? These values use exactly the same formula as in the cells above, but for somehow they are not fetched. I mean, this problem doesn't occur all the time or with all the stocks, but sometimes it just happens. Even with reloading, it doesn't go away, right? So what we do is we basically take the next value. In that case, we just take the next value. It usually doesn't happen that so many values are like not available that you cannot get a correct picture. But yeah, that is how we deal with this, and that is why the formulas are a little bit I mean, they don't look as simple as they should be ideally. So you just change the stock name here. So this is for Trent. Let's say I need to get the Sharpe and beta for Colpal, right? So I enter it here. So these values will reload, and you get new values for 12 month, 9 months, 6 month, 3 month, and then you get the average, which is obviously less than Trend. You get the beta, which is also less than that of Trend. But yeah, so this is basically how we do. One major thing that is that I want to say is that this is just for exploring how to calculate the Sharpe and beta of any particular stock. This is not scalable in the sense that you can rank the stocks, at least not on this sheet. Obviously that can be doable, but if you try to put 500 stocks and run this in this same sheet, it doesn't work for me, at least on Google Sheets. You can try it out, or you can maybe try it out in smaller batches. But a more efficient way would be to use AppScript for this, or a separate Python code altogether. So we'll look at that in some separate video. Okay. So anyway, so this is what I had to discuss on how to calculate the Sharpe returns for any stock using Google Sheets. Let's go back to the slide, and let's take a little bit of look at the markets as we had discussed. So markets do show a return to bullish times again, and there is a huge chatter that banking and financial services stocks are going up, and FIIs would be putting most of their money there, and these stocks are going to have a huge run up. We haven't seen I mean, the run up has just started. I think HDFC Bank also gave really nice returns over the past 4 sessions. We haven't seen a lot of banking stocks coming to the momentum portfolio, but if this performance continues as and when they continue performing, there is a very high likelihood that they might come, although not the very large stocks ideally. Trend has crossed 150% mark on portfolio. So this is just so you can see the portfolio here. Let's take a look at the portfolio. So Trend has just crossed 150%. Good session on Friday as well. Okay. Oil India, you can see here, Oil India has dropped more than 25% from the all-time high. So we'll reassess this on the next rebalancing day at the end of this month, whether it is still below the 25%, whether it is still fallen more than 25% on the rebalancing day. And if that is the case, then we'll have to exit that stock, even if it is within the 50 ranks, right? And yeah, So that is just one concern that I see on the portfolio. The Zomato, Kalyan, Inox Wind race is continuing. You can see Kalyan at 93%, Inox Wind has inched up to 90%, massive gain in the last day, almost 7.5% up. So Kalyan Jewelers is at 93, Inox is at 90, and Zomato is at 86. So again, all three of these are like bunched up and going pretty close, and competing with each other, and let's see who wins out as we go on. Gold has continued to remain strong, and I am also continuing to invest more and more and increase my asset allocation in gold as well. If we talk about Bitcoin, that has also reclaimed. So Bitcoin had seen quite a bit of weakness in recent weeks, but it has again quickly reclaimed 60k, and it is currently, I think, around 63k post these rate cuts. So US markets, Nasdaq, S&P, Bitcoin, everything is showing currently. Gold also is showing bullish momentum. Let's see how far this continues. But a very quick thought which I always share is that if you look at the Nifty returns, this is just Nifty 50, right? Returns in the past year, it is 30%. If you look at the average CAGR that we usually get in Nifty 50, it is said to be around 12 to 13%, right? So years like these, we should be grateful that the markets have been very, very generous, but we should also be very realistic that these times do not continue, right? It's not that Nifty is going to give you 30% every year, right? If it gives 30% for a year, maybe it will go flat for 2-3 years. I'm not saying that it will, but I'm just saying that it can happen, right? So we should always have that reality check in the back of our heads that I mean, getting 50%, 40% returns is no big feat if the Nifty itself is giving you 30% in a year, right? So we should be very, very realistic, and we should be very, very stoic about it. In fact, we should be kind of expecting the market to have a little bit of correction, to have maybe a time-wise correction, right? So at least it gets some breathing room for the next rally. Otherwise, if it rises too fast too soon, then we do not know, because the falls after that will also be very, very sharp and very, very harming for a lot of investors, right? So that is the thought that I would leave you with. Let me know if you like this video, and if you have any questions on the Sharpe bit also. And if you are watching this video for the first time, if you aren't aware, then we have been tracking this momentum portfolio for almost 9 months now, and all the entries, exits, whenever we make, we share it with our videos, with our posts. So if you want to be a part of this journey, then please consider subscribing to this channel. And video अच्छा लगे तो like ज़रूर करना. बाकी see you next week. Till then, take care. Bye bye.